heading into Q4 of 2023.
And then just the reality, these labor markets are going to continue to stay very tight.
55 and plus age workers continues to lag participation rate.
You can go look. I mean, it's happening.
Interestingly and positively, it's growing quarter over quarter, which we expect that.
That trend is not changing.
Well, hello and welcome again to the Skillwork Forum. I'm Tim, as always, joined here with my partner, Brett. And we always just gather on these podcasts, talk about emerging issues, industry trends, really everything surrounding the skilled trades. And today, as we're recording this, we're just heading into Q4 of 2023. So we've come through 3 quarters of this year, and we thought it'd be a great time to take a look at where we're heading from a broad economic perspective, both here domestically as well as globally. And what is the impact of that in our area of interest, which is the skilled trades and particularly the manufacturing? So we're going to cover a few things today just to kind of upfront talk about what topics we'll be brushing on today. Brett, there's probably 4 or 5 things we're going to bounce around here and talk about. First couple of ones we're going to talk about are wages. That's really an important issue, both whether you're paying them or earning them. So far, the news is good from that perspective, up 4.2% year to date. We're going to talk about that a little bit and about the impact of inflation. There are those that believe we've reached the bottom or the peak, depending on how you look at it, of inflation. The inflationary pressures are starting to slack a little bit. We'll delve into that, talk about the overall GDP and state of the country, what that looks like. Are we bullish? Are we more of a bear mentality heading into 2024 and beyond? And then just the job market overall. Are we getting any slackening or any improvements in the overall job market? A few other things we're going to talk about too.
Yeah. So we'll kind of dig, like you said, into a few of these, both the spending in construction and manufacturing, and how that's trending up. Obviously, construction tied to manufacturing because of the push that we're seeing on building, onshoring, as we would say, versus offshoring some of our manufacturing. We'll talk about that. And then just the reality that these labor markets are going to continue to stay very, very tight. That trend is not changing. I think the number is still 9 million open jobs and 5.5 million people to fill them that are looking. So that's going to stay tight. And then globally, the dollar, even though depending on where you're getting your information, if you really look at the overall numbers, we'll talk a little bit about, not in super detail, but kind of what's going on in China and Europe and that and whatnot. But globally, the dollar is strong and showing signs of continuing to strengthen.
Yeah. So particularly interested in hearing your thoughts on this offshoring to onshoring manufacturing. So I think that really is going to be an impact. So we'll take these as we come across them, as we discuss. We're going to tee them up. First of all, talking about wages. Talked in general, overall, the average wage has gone up 4.2% for the year. So in terms of manufacturing and construction sector, the average hourly earnings of those workers and those sectors rose about 0.5% in the month of August and continued to rise in the month of September. So we're just getting those numbers right now. So the average hourly earning is pushing up around about $26.59 or, pushing almost close to $27 depending on where you are at. That's a 5.7% growth in wages over the past 12 months. Of course, at the peak of inflation, it was outpacing that, but now average inflation year to date is 3.7. So that's a 2% real growth in the power of your dollars to earn, power of your wage increase. So that's a significant number.
It is, yeah. I mean, when you look at, like you said, with the peak of inflation, I think we got up to like 9.1% or something like that inflation rate. And at that point, wages couldn't keep pace, which it basically, meant, people were out of pocket, for that. So now we've seen that come down to that point, like you're saying, Tim, where actually the wage increase. Now that doesn't mean, if you're listening to this and you're going, well, I'm not feeling any of that, good news. And so that's reality. I mean, if you're a young family or not even a young family, but you're paycheck to paycheck and it's costing you $200-$300 more a month, that's real.
Yeah.
But the numbers are the numbers, and the numbers say that the wages, are now outpacing inflation, which is still higher than we want at 3.7 or 4%. But we'll talk about where we think that's trending, and this isn't just for the record. Tim and I are not economists, and so this is information that we have gleaned from some very reputable sources as we study it, look at it, and understand how it's impacting our business and our clients' businesses. So these aren't really our numbers per se.
I did take economics in college, so that was like 700 years ago. But
it was probably a
we were
different
using abacus, and,
but I'm not sure what they were
gold and
talking
silver
about at that time. Where we can relate it specifically to us here at Skillwork, and what we do, we're seeing that same increase in wages. So we deploy, skilled trades individuals, maintenance technicians, and automation, and so forth. And we've definitely seen, our average. I think probably 3 years ago, even 2 years ago, our average skilled worker hourly pay was averaging around 25 to 26, kind of close to that 26.59 that you mentioned a minute ago, which is broader spectrum. But in ours right now, I think the average is closer to 29. So we're seeing, and a lot of that is being driven, which we'll probably talk about a little bit more in this increase of automation, and those wages are higher. So I think, what we're anticipating and what we're hearing is, if you're running a business, we're going to expect to see higher wages, going to have to improve those benefits. And there is a need. It's harder in our space. And, if you're a maintenance person in an industrial manufacturing plant, the idea of working remotely isn't very realistic. But there is the ability to create more flexibility. So definitely employees are looking for more flexibility, but that could be in shift sharing and a variety of different things. Flexibility doesn't mean I get to work from home 3 days a week.
Yeah. I mean, in our space, it's more taking advantage of AI and virtual reality and augmented reality. And we've talked about that on the podcast. So rather than have to come in the middle of the night because of, a piece of equipment has gone down, maybe you can troubleshoot that remotely, giving you more flexibility, those sorts of things. But how we figure that out, a lot of it remains to be seen, but I can tell you the fact remains that the up and coming workforce expects it. So that's the reality. And I think that one of the economists we listened to said something about the numbers are the numbers, and you can ignore them. And an interesting thing about economic things, like you talked about, even though it may not feel like that, there's an actual metric they track, how people are feeling about the economy. And that always lags the real numbers. You're going to continue to see people, even as these numbers hopefully continue to slowly rebound, feeling out there is going to lag probably 6 months or so. Again, we're not economists, but we do pay close attention to it. It's necessary. So the next topic we're going to talk about is overall, how's the country doing in terms of production, in terms of GDP is the measure we typically go to, gross domestic product. It's the number that kind of captures how much we're producing as a country. And interestingly and positively, it's growing quarter over quarter, which we expect that. I guess I've heard, that at least the one economist we heard speak recently was pretty dogmatic in saying that we're going to have a slowdown in Q4 because of a pending government shutdown. You guys all know, when you hear this, we recently went, the threat of that happening, and they extended it out like they always do, 45 days, kicked it to the right. In Q4, that's going to come up again. So we may have a slackening Q4, but a continued soft recovery with, less fears of a deepening recession, which is really good. We talked a little bit about inflation. Appears to be easing. The projection we saw at the beginning of this year were all doom and gloom through next year. The thought now is we may see inflation rates getting back into that 2.5% to 3.5% range by the middle of 2024, which is a heck of a lot better than 9.
Far better. And so I think that, one of the chief economists said he's calling it the great rate reset. And so I think it's, if you're running a business, if you're like hey, we're going to talk about here in a minute about the boom of manufacturing and new manufacturing that we're seeing coming back, to the States, hey, I want to get in that and so forth type of thing. I built a new production plant in 2004. And so, it's crazier things have happened than people going out and going, hey, can I raise the money and can we do it? And I've always said, I don't know if I could do it. Again, I don't know if I could get a bank to be crazy enough to loan me the money. But we did it and it worked. And so, but I think money in general, rates are going to get higher. The idea, we kind of got ourselves into a scenario over the last, I don't know, however many years, but where literally money was free. I mean, you were literally borrowing money for free. And, anybody that's got a mortgage on their home right now, if you didn't refi, I don't know why, but you're probably paying 2.5%, 3%, which is going to be a real challenge. And it is a challenge right now. My wife's a realtor, and now, she's selling houses and people, are borrowing money at 7.5%, and so if you're borrowing money at 3, do you really want to sell your house to borrow at 7.5? Now, if you have cash, that's not a problem. But the reality of just, of higher numbers, one of the things too, and I think it's one of the reasons why we're seeing a little bit of settling in the markets, there's a pretty strong, even a month ago, most people thought the Feds would raise the rates probably one more time at least. And the market was showing that, and so forth. Now seems to be a pretty strong indication that they might be done. And so we're beginning to kind of see that level out a little bit. But we're just talking about mortgage rates. I think the reality that mortgage rates are going to be in that 6 to 7% is probably realistic. Like to think they're not going,
8 or 9 or whatever.
Way up there. I think probably when we bought our first houses, they were
8%.
Yeah,
Yep.
And so, but that's probably a normal rate. 2 and 3% and free money is not really reality. So we are going to have to adjust to that. A healthy economy, a little bit of inflation, probably 2.5% or less, kind of normal borrowing rates. But it is going to, if you're a small or mid-sized company and you're borrowing money, you're going to pay more for it. You're probably going to be, if you're a semi-high risk, you're probably going to be north of 10%. It's 8% right now. If you go out and build a house or build a manufacturing plant, you're going to be probably at best at 8. And if you're risky, you're going to add, basis points to that. And so good chance that the money's going to be a little bit more. So the other thing, and when we talk about it, from time to time, when you look at the overall economy, there is a huge amount of money on the side. And so, numbers that, begin with not M's or B's, but T's.
I think the idea is, as business owners, and I think we got to get our head around the facts, historically speaking, as you alluded to, Brett. Staying sub 3% when inflation is running ahead of that, banks are, you're basically making money by borrowing it. I mean, if you think about it in real numbers. So that is just untenable. Likewise, we don't want to see 8, 9, 10% either. So normalizing, hopefully by mid next year, 6.5 to 7.5 range for a while, probably be the new normal. Overall will help it. The job market is the next thing we want to talk about. And it's still super tight, especially in our sector. And it's not going to get any better. It's going to stay that way for the foreseeable future. So wages are going to increase. Demand is going to increase. Supply is going to continue to blacken and weaken. There is a couple of, positive things to speak about in the job market. Overall, when you take a look at across all sectors, participation rate is the number of working age eligible people are actually participating in the workforce. It is improving slightly overall up to 63%, which doesn't sound great, but it's a heck of a lot better than it has been. And the prime age workers, which would be those 25 to 54, it's up around 83.5%. So the bulk of the workforce 83.5%. We'd like to see it, above 90, but that is improving. It's the highest we've seen since 2002. So that's good news. We talked about, the dropout that's happening out there. And I'm hoping that we're seeing that reverse. We need it to. But here's the downside of that. That's a little bit mystifying. We heard a couple of reasons why. 55 plus. So really on the tail end of the baby boomers, 55 and plus age workers continues to lag participation rate, currently at 38%. 55 plus workers eligible to work, working age workers, 55 and plus, only 38%. And according to one economist, at least, and others we've seen, is that's not likely to recover. So what does that mean? 55 plus, you think about, those are really your high-end skill guys, experienced guys who know how everything works. And fewer of them are working. We already know that the COVID impact of accelerating baby boomers exiting the workforce, this is going to make it more really experienced workers that you count on. So the emphasis towards automation and upskilling your on emerging workforce is going to be crucial.
Absolutely. Yep. Yeah, it was a really surprising number. I think, but if you're looking, at the overall, like I said a minute ago, there's 9 million open jobs and 5.5 million people looking. So you have to start to look and say, okay, how do we fill that gap? Well, the reality is we're not going to fill the gap, but I think this 83.5, I think those are males. I think the females, I think if I remember, it was around 77%.
That's right. Yeah, these are the males. That's right.
It was 77, which would say, okay, there's an opportunity to get more females into the manufacturing, and some of this is kind of crosses beyond just manufacturing, but that's really where a lot of the focus of this conversation and the economics are. But and then that number, as Tim said, if you have individuals, with well over 20 plus years of experience that are sitting on the sideline, that's a huge opportunity if we can get them back into the workforce in some way. So, manufacturing, overall, I think in August, we added about 16,000 jobs. Overall, the number was 260 or something like that. I think they're projecting that number will probably stay in that 220 to 30, 40, growth number, but it's still gonna trail quite a bit what the need is. The workforce issues continue to be the number one issue. I think the most recent NAM manufacturing, it's still 71% of manufacturing companies and are still saying it's the number one risk. One thing that we heard at this recent manufacturing alliance forum that we attended was the statement. I want to qualify this a little bit, but they were basically saying, because of this gap and because 71% recognize this is our biggest issue, it's either immigration, automation, or don't grow. Now, before we go, let everybody in. So
legal immigration.
Yes, think about it from a standpoint, not necessarily. So this was a state thing. We're in the state of Nebraska, and this was for the state of Nebraska. So don't think of it. It's more of the idea, how are we going to attract people to Nebraska from California from other states? So here it doesn't mean necessarily, an immigration policy per se, but you've either got to attract more people in to your jobs, which means your state has to be more attractive than the one they're leaving, or you've got to automate, or you just don't grow.
Yeah. Yeah. It's interesting to me that the first time I got something that kind of made a little bit of sense why participation rate in the 55 plus is dropped off the cliff in COVID. And the assertion was, and it was backed by some metrics, that due to the number of deaths, unexpected deaths that happened over COVID, that the transfer of wealth generationally from some of the older established couples who had wealth set aside and saved up. Their unexpected and untimely death sadly accelerated. We can get into the why of that, but a lot of that wealth transfer went to these 55 and plus that were expecting to work another 10, 12 years or whatever. And all of a sudden they have this wealth and they kind of like the idea of not working during COVID and being home and traveling around. And they just said, you know what? I think I'm good.
Yeah.
And so that explains why a lot of them aren't working. And I thought for the first time, I said, well, that makes sense. And I talked to peers my age and some even older than me, like that are Brett's age and even older. You know, there are many of them that we run into now. Maybe it's just because we are getting older. They're like, yeah, I'm retired. I'm about to retire. I'm doing this. I'm like, all right. It's an interesting thing, but it is going to affect the bottom line from the perspective of need for experienced workers. So a couple other things we want to throw out there that kind of such a grab bag of topics. Spending trends. And spending trends, of course, drives demand, which drives what you produce and drives manufacturing. So they're connected. Post-COVID now, everybody considers us in the post-COVID or post-pandemic era. So the spending is starting to trend away from durable goods that really drove the economy during COVID years and after. And durable goods were like people buying for their house and exercise equipment and home improvement and appliances and bigger screen TV because they're spending 18 hours a day in front of their television at home working remote. But the trend is going away from durable goods and more towards services. And this is a return to pre-COVID. Service sectors really drove a lot of the economy, and it's shifting back to that. So by services, travel, entertainment, think of things like that people have been wanting to do and put off. So if you're thinking about traveling somewhere on vacation, you're waiting for like airlines to come down or hotel fees or that to come down, probably not going to happen anytime soon. The demand is out there for that. So people want to get out and start living again. So it's driving that consumer spending. The other thing, and again, you know, far be it from us to be a domestic economist or economy specialist, and when you start looking globally, it really gets tricky, but just some things we've heard will affect the supply chain here. Everybody looks at China as this big threat, and they are, perhaps even an existential threat downrange. They are having a lot of financial instability right now in their country, much more than we are. And Europe also is feeling a lot more recessionary pressures. They're going to be having problems. European Union is going to be having challenges. Meanwhile, the dollar, as Brett alluded to, is beginning to trend and looks pretty strong. The war in Ukraine continues to be a drag. Now, as you're hearing this, we are just taking in this significant event going on in the Middle East between Israel and its enemies around it. And that is going to have a big impact as well. So a lot of stuff is happening globally that may accelerate this onshoring of manufacturing work and dollars flowing back into our country here over the next several years.
100%. No, there's a lot going on in all of that. And probably a couple of the biggest impacts of that is it's arguably not that debatable now that, I mean, China economically is in a hot mess. And they have some serious issues in their economy, and that because it's a combination. So because of the instability there, and because of during pandemic, we had offshore, specifically semiconductors and those kinds of things,
Pharmaceuticals,
and all of a sudden, certain things in this global economy, idea all of a sudden, didn't seem like that wasn't working as well. And so, the idea that we're going to bring that manufacturing back to the States, that is, you can go look. I mean, it's happening. I mean, it is happening. And so we're moving production from China back to the U.S. Now, the obvious challenge in that is, well, where are we going to find the people? And that's where the automation is going to come in. But so a combination of one of these economists had indicated that right now, and this isn't so much a projection or a prediction as much as of a reality. We're watching it happen. Between the last two administrations, they both poured a fair amount of government dollars, our dollars. Government doesn't have any dollars. Into infrastructure and into, you can look it up. I won't try to be an expert into what's called the CHIP Act, which was a specific move to bring semiconductor manufacturing back to the U.S. That is underway. It's happening. Yep. I mean, those plants are being built, and so this economist had indicated, Tim, and this even predates you, in that
does.
in the 40s. See, I always get back when you get that jab at my age.
Well, I was going to ask you what it was like then. So, I wasn't.
So that we're going to see a manufacturing boom of new manufacturing over the next 5 years in the U.S., unlike we've seen since the 40s and 50s. And so the amount of new, because we're onshoring it back. I just read an article briefly this morning. We have another business partner who lives down in Dallas, and he had shared an article where this individual, very knowledgeable, speaks into this a lot. We're talking about that he believes that we'll even have to do more partnering with Mexico in order to be able to handle the amount of manufacturing. So if you're in the manufacturing space like we are, I'd like to think we're not just, reading our own, good news, but I think if the manufacturing space in general, there's a lot of dollars, government dollars, to some degree that are being pushed into that, but we're seeing it happen. Those plants are getting built.
And the other thing too, along with needing to bring in more people that are open to career in the skilled trades. And I think I'm hearing more and more of just our culture talking about it. 2 years ago, Mike Rowe was on with talking.
Yeah.
Now it seems like everybody's talking about the opportunity we have in skilled trades, and how, that it is not the manufacturing of your parents. So I just encourage anybody out there, even those of us that may have kids or even grandkids coming, don't dismiss the idea of somebody going into a skilled trade. It is an incredible opportunity, incredibly challenging, incredibly technical, and tremendous opportunity to on-ramp to owning your own business. We talk about that a lot in a lot of our social media, and we continue to back that. So, just to kind of summarize what we talked about here today, depending on what you look at, you can get doomsday people as well who are not seeing this as much, but I think the ratio we heard that it's about a 60% feeling that we're bottomed out on the recession, we're going to get better, and there's still 40% or so that think no. So it's trending in the right direction. It's being called a resilient expansion, meaning despite some of the factors, the economy continues to do pretty well. I don't know how this global impacts are going to affect things. We need to keep an eye on that, of course. Tight labor markets, Brett, we talked about that, driving the need for automation, modestly increasing wages and benefits. Manufacturing and construction should see significant investment, which you touched on and founded on quite a bit. So all in all, we believe going into this Q4 of this year and getting ready for next year, even though the government shutdown is looming, that may impact things short term. I think we're feeling a lot more confident about where we're heading. That's in the economy in general, and at least that's our expectations we sit here today. So hopefully these things were helpful to you, and we're able to give you a little bit something to chew on or look into, maybe delve into on your own. Appreciate it. You give us to be a part of our Skillwork family here. Blessings on you. Until next time, great day.